You know, I came in this morning, I do what I always do on the Monday after a Friday jobs report. I look at what economists did to their growth forecast, and it looks like 4 is the new 3, Bill. At least 4 of the 9 guys that I looked at this morning have a 4% handle on second quarter growth. With a big question, is this a bounce back from just the depressed number in the first quarter, or is it a sign maybe we're ratcheting up to a new level? We've had a bunch of data come in stronger than expected. And let me draw you one of my famous air charts here. Here's what everything looks like. January, February, March, and now April, doing even better than that. So, and I don't mean to say it's off the charts, it's off here. It's more like down here, but everything's showing a sequential increase from the winter weather woes.
Is that just, and this is going to be important for people trying to wrap their heads around, for example, what interest rates are doing. Is it just for the second quarter? How much of how sustained
now,
is this?
I looked at that.
I
looked at that question. What I saw was a lot of guys sticking to 3% after the 4%. So they're not ratcheting back down to the 2.25 we've seen. So the optimism is out there. Doesn't make it a reality. It just tells you where people are thinking right now about where growth is going. You did 0.1, probably negative 0.1 right now in the first quarter, 4%. So you're still averaging 2. We're going to need to do a lot better to get to a 3% handle for the whole year.
Yeah. And speaking of 3%, why aren't we at 3% on the 10-year, Rick Santelli, if the expectation is for 4% growth in the economy, right?
Because everything Steve's saying is back to the future. I can point you to quarters we've already had 4%. Think 2012. And when you have 0 in the first quarter, even if you have 5% in the second quarter, you have 2.5. And I find it so fascinating that we have so much good and bad that many like to only concentrate on the good. I think you need to talk about both. And what am I referring to? January, February, March is the first quarter. April, May, June is the second quarter. We're 1/3 basically through the second quarter, and everybody's already talking 4 to 4.5% GDP. And it really goes to explain that, you know, if all you have is cobblers on TV, everybody's going to need a new pair of shoes. And the reason we're not at 3% is because we don't have a 3% economy. But it's not a horrible economy, because as the charts show, a year ago, we were at 160. In July of 2012, we were at 140. So we're better than we were then, but we're not quite good enough. And that's why the curve, in my opinion, is flattening. Because crisis management is crazy. So the short end's refuting the Fed, and the long end is refuting Steve.
Well, trying to take it too personally, Steve.
Does Steve get to refute Rick, or is that later? We'll do that later. Okay.
I just want to ask John Rutledge real quick for his view amid all of this. John, how sustained do you think markets are telling us the growth year is going to be?
I think it's extraordinary that people are surprised that it warmed up in May. You know, we've seen summers before. It's going to be warm all the way through the summer, folks. That doesn't mean the economy's growing. I believe that the economy is growing some. It's growing a little bit in Europe, a little bit in Japan, not enough to get excited about. And the reason the 10 years down is because Putin is back. Our old friend, the Soviet Union's here again. They're not going to be so easy to deal with this time, because they're now run by an uber capitalist who's got everyone in the world on their knees.
You know, I read a commentary today, Peter, that said that if there were no Ukraine crisis right now, that the 10-year would be at 3% right now. Do you buy that? I mean, 40 basis points? I'm telling you, I'm just telling you what I read, Rick.
Well, you know, I think
there
could possibly be a chance that it would be at 3%, but I don't think growth, I think that's a little heady to say growth is going to be at the 4% level. I'm looking for more like 2 to 3%. And with regards to the Treasury, sure, we're going to have pressure on the Treasuries, but remember, our friend Janet Yellen is out there saying that we're not going to put much pressure on interest rates for 2 years. You know, one of the things I'm dying to talk about is this merger and acquisition activity that's out there. We can speculate on the growth and where treasuries are going to be. But let's talk about some hard data that we're seeing right now from the first quarter going into the second quarter. That is, companies, smart companies, are buying other companies. They're not financial buyers, they're strategic buyers. And I think that's a very, very strong indication that there is the risk-reward spectrum right now is tilted more toward the reward for us.